able to see me?
Yes.
Is it clear? Are you able to see the image?
Yes.
Can you hear me as well?
Yes, I can hear you, Cayden.
Are you able to hear the laughter in my class?
Not with me, not at me.
Okay. So right now what I'm going to do is maybe just go for a couple of seconds. I'm going to introduce you to the class and then I'll come back to you. Is that alright?
Yes.
Okay, just give me a second. Okay. Just go on to the Skype call. So I'm going to do is I'm going to change the slide. Okay, let me go to this part. Last part. Okay, so ladies and gentlemen, before we start now, this is the background for Scott, and he's right now in Florida listening to all of you. So ladies and gentlemen, I just need a small favor from all of you. So ladies and gentlemen, can we give Scott a huge round of applause? Thank you, so that you can hear. Scott, can you hear that? Are you able to hear the
yes.
over in Florida?
Yes, I can hear it. Thank you very much. Thank you.
Okay, very good.
It's a pleasure and an honor to be here.
Okay, very good. So later on, I'm going to shift my laptop a bit. So let me give an introduction about Scott. Now, this one is the profile of Scott, and just to share with you that I met Scott in the Nebraska, the AGM. We happened to be there, and actually the first time I saw him was in Nebraska University. So I was attending a 2-day seminar with fund managers and so on. And Scott happened to be one author, and he was displaying his book outside. Okay, so I came out, I saw this handsome young man, and then I started talking to him. And he has one of his best friends called Dr. Butler, who's originally from Philippines. So two of them are very good friends. Okay. Then another session I'll talk with Butler again. Let me come back to Scott. Now Scott, by the way, Scott Thompson is the chairman and CEO of this company called Ameritrust Group, and previously he was managing director of this intrinsic value capital. So now he managed funds using value investing methodology. So as you can see over here, Scott is a disciple of value investors, Warren Buffett, Charlie Munger, and all the famous investors. And he's really, in the US, considered an expert in identifying undervalued assets. And Scott, by the way, is an international best-selling author of this book called The Art and Science of Value Investing. So I was really very lucky. So Scott, I still have the book. Whether are you able to see?
Are you excellent?
Yeah. Okay. Very good. I still kept it. This is true. So yeah, I still kept the book, and Scott's given me lucky, and I got his signature. Okay. So Scott is the international best-selling author of a book called The Art and Science of Value Investing. And if let's say you later on, I'm going to circulate this book around and make sure they return it back to me. Now at the back of the book, you can see Scott with Peter Buffett and with Warren Buffett. So it's very rare that somebody actually gives him permission to put Warren Buffett's face on the book. So this is multiple. This is very precious. This is worth like billions. Now, so Scott graduated from Northern Illinois University. This one, sorry, I can't see. He graduated with a summa cum laude and then earned a graduation. After bank, he worked with several Fortune 500, Bank of America, BP. Oh, by the way, in addition to all the high profile that Scott has, he's also a philanthropist and has donated a huge amount of money and volunteer. Let me see over here, hours. So Scott serves on numerous board and charity organizations, including the 5th Rehabilitation Healthcare Organization in the US. So Scott speaks at investor conferences, book signing seminars, and if let's say any one of you in this room, you want to contact him, you can just drop me an email at info@provaluesource.com. Okay? So right, Scott, are you ready?
Yes.
Are you ready? Okay, so what I'm going to do is, I'm just going to do a small thing. What I'm going to do is, I'm just going to rotate my laptop a bit so that you're able to see the class. Okay, so in my class right now, there are approximately like 50 plus people, and then the remaining will be around 1,000 people at home. Okay, so okay, so give me a second. Singaporeans are quite hardworking lot at home.
Great.
Okay, so I'm just going to rotate. Let me see whether you can see. Let me put the step back up. So I'm just going to rotate so that I can see. Yeah, can you see the class? Are you able to see the class? Okay, so ladies and gentlemen, can you all wave to Scott, ladies and gentlemen? Okay, all of us are on 3. You all say hi. Ready? 1, 2, 3. Say hi. Yeah, so this is what's happening in Singapore every single month. All these crazy people. Now, which are all my friends. So Scott, what I'm going to do is I'm just going to start right now. But before that, I sincerely appreciate your time. I know you're a very busy man, and you know,
enjoy.
Yeah, and you're helping this as a friend. So I'm really thank you. So right now I'm going to just start this interview. So I hope that I can catch you in the next meeting in probably in Nebraska, and I'll buy you a huge meal. But before that, the first question, ladies and gentlemen, later on after I ask all my questions, I'm going to pass the question to you. Not pass the question, I'm going to pass the mic to you, and you can answer. So the first question is I happen to watch you and Peter Buffett, in a music jamming session on YouTube. So if yeah, exactly. So if let's say I'm a I'm a newbie investor, and I would assume Peter is an investor as well. Can you just share about Peter, what he does, and how you and Peter become great pals?
Sure. For those who aren't familiar with Peter Buffett, he's a very talented, award-winning musician, author, and billionaire philanthropist. I'm certainly not a spokesperson for Peter. He can speak for itself, but I met Peter at a nonprofit event back in 2009, and we spoke after the event, and we had a lot in common. And Peter and his team invited me to join them for dinner, and we've been friends ever since. The video that you saw was right after a nonprofit event that Peter Buffett and I organized to benefit children with disabilities. And after the event, we went up to my 47th floor office boardroom.
Yeah.
It was totally spontaneous. And I broke out my guitar, and we started jamming one of Peter Buffett's songs, and the rest is history. It was just a very fun, spontaneous moment. And like I said, the event was a nonprofit event, and philanthropy is very important to me and also to the Buffett family.
Wow, okay. And the next question goes something like this. I was talking about a book that I got, and it's still here with me. And I just want to let you know you're talking about this Peter Buffett endorsing book. So in other words, Peter Buffett actually wrote a foreword for a book and so on. And can you share about your experience in this instance? I mean, Peter Buffett is somebody. Everybody knows that Peter is actually Warren Buffett's son. So he don't really endorse inverted commas per se. So how do you really get this thing done? I mean, he's on your side and he's supporting you in this journey, investing and so on, and endorsing also. Can you share about your experience in this case?
Yes, thanks for asking, Cayden. I've been, like I said, I've been friends with Peter since 2009, and as our friendship developed, I sent Peter a copy of the table of contents, and later a copy of the book, and I just asked Peter if he'd be interested to compose the foreword in my book, and I talked to him a little bit more about the book, and what Peter really liked about my book, I think, is that we both believe that the definition of success is more about happiness and less about money. And Peter Buffett really liked the fact that the final chapter in my book is about responsible philanthropy, and not just about how to earn money, but also how to responsibly give the money away. And many times, as Peter's father Warren says, giving money away responsibly is often can be more difficult than earning it.
Yeah, exactly. So that's how we got everything all started. Yeah. So maybe you can tell us, how do you get started in value investing in the first place, other than the philanthropy activities that you have? Sure. As
those who follow Warren Buffett, back in 1988, Warren Buffett invested a little over $1 billion into the Coca-Cola company, and I read about this, and I've been studying Warren Buffett ever since, because back in 1988 I was relatively young and enjoying the Coca-Cola products as most young people do. And I thought it was interesting that he would put $1 billion, which is a very large amount of money in the 1980s. It's still a large amount of money now, but even more back then. And I was fascinated by that and really sparked my curiosity. So I started reading the Berkshire Hathaway annual reports. And it's interesting, the value investing, it's more of a mindset because it's more of a long-term hold. It's not a short-term day trading. And if you buy high-quality assets for less than they're worth, you're going to make a lot of money.
Okay, so the next question goes something like this. Now, if let's say, by the way, let's just do testing, okay.
Yes.
Now, so those people that are sitting in class, in fact, they are actually a graduate of my academy, so they learn value investing as well. So let me do a test check again. Sorry about microphone. Testing. And we always talk about selecting stocks using certain qualitative and quantitative criteria, and we have our own list of criteria and so on. So I just want to hear from you, if let's say there are certain criteria, for example, whether it's qualitative or quantitative, that we can really identify great companies. Can you just share with us your opinion, and maybe you could illustrate some examples?
Yeah, that's a great question. As you mentioned, Cayden, in value investing, there's quantitative criteria, and there's also qualitative.
Yeah.
When Warren Buffett started investing, he was patterned most of his value investing style after his mentor, Ben Graham. And as we all know, Ben Graham was very quantitative and really almost not qualitative at all. And as Warren Buffett developed throughout his value investing career over the decades, Charlie Munger and Phil Fisher influenced Warren Buffett to become more qualitative. So to answer your question, the more qualitative factors, Buffett and Munger developed a 4 filters investment process. And of the 4 filters, the first 3 are qualitative. So, for example, filter 1, it must be a business you understand. So that's a very qualitative factor. So if you don't understand the business, you shouldn't invest in it. And the business you understand, that's going to be different from me and you and each member of the audience. Each investor should decide what they understand and what they don't understand. For example, Warren Buffett does not invest into technology companies. So Warren claims that technology is outside of his circle of competence. So filter 1, it must be a business you understand. The qualitative factor number 2 would be must be a sustainable competitive advantage. So some examples to answer your question of sustainable competitive advantages would be, if the business, for example, has patents. For example, sometimes pharmaceutical companies have patents, or maybe they have a large brand like Coca-Cola. Coca-Cola also has a large global distribution. These are all qualitative factors. Also, if a company is a low-cost producer, or what Warren Buffett talks about is a moat, pricing power, where instead of being a price-competitive business, the company would have pricing power and a very rapid rate of inventory turnover. One example is you can sell a glass of lemonade for $1, or you could sell, you could sell a glass of lemonade for $1 million, or you could sell 1 million glasses of lemonade for $1. Warren Buffett likes a very wide profit margin and very rapid turnover. And then the third filter of the qualitative filters would be you need to find a business with able and trustworthy managers. So one way that Warren Buffett looks for able and trustworthy managers is he might read the annual report from, let's say, 5 years ago or 7 years ago, and then he reads the annual report today of the current year, and he'll notice, what did management promise, 7 years ago or 5 years ago, what were the goals they set, and did they achieve those goals or not? So that's a way to test for able and trustworthy managers. So those 3 would be the primary 3 investment filters, the qualitative factors that Warren Buffett and Charlie Munger look for.
Okay. But because Warren Buffett don't really invest in technology, and we all know that the last couple of years he was buying IBM.
That's right.
Yeah, exactly. And just like you mentioned about the honest management, and the IBM keep talking about the management where they have this roadmap, where they have target earnings per share, and then they keep on hitting it. So are we right to assume that this is how Warren Buffett look for able management? Is that what we're looking at?
Yeah, IBM has been in business for, for years. And remember, IBM, although it's a technology company, I think the important factor that many investors overlook when they examine, why would Warren Buffett finally invest in a technology company after, almost 50 years. And remember, IBM is also a service company. They have service contracts in place for years and years into the future. So as we know, Warren Buffett would never invest into a business unless he can look out into the future and know what the business is going to look like. So I think a big influencing factor of Warren Buffett investing into IBM is the fact that IBM has these service contracts in stock, which a large percentage of IBM's net income comes from these service contracts. So although IBM is a technology company, they're also a big service company as well.
Okay, great. And just now you're talking about 4 filters, and then the first 3 are qualitative, and what's the last one, the quantitative one?
Sure. The filter number 4 of the 4 filters is price to value, also known as margin of safety. And that's where we look at price is what you pay and value is what you get. If a company is worth X amount, Warren Buffett would want to buy the company for X at a discount. In the past, Warren Buffett would get 50% margins of safety, but now working with large sums of money, we all know Warren's working with billions now. It's very difficult to get the 50% margins of safety. So now Warren's returns have went from 40 to 50%. Decades ago now to I believe it was just under 20%, which is absolutely outstanding after 50 years to have that type of long-term track record. So yes, you're right, Cayden. The 4th filter is price to value. So that's where you would look at, what is the intrinsic value of the business, and then what is the price. If the company is worth, let's say, 100 million Singapore dollars, Warren Buffett would want to invest in the company with a wide margin of safety of, say, 70 million Singapore dollars, or just at a discount. and not pay full price.
Okay, just now you mentioned about the margin of safety. You're saying that across the years the margin of safety has reduced, right, from 50%, and then did you mention 20% just now? The margin of safety.
Warren Buffett's mentor, Ben Graham, developed the concept of margin of safety, and that's been a staple in Warren Buffett's investing philosophy throughout his entire career. So in the past, Warren Buffett would get wider margins of safety back when he was working with only millions of dollars, but now working with billions. Warren Buffett is getting still a healthy margin of safety, but nothing close to 40 and 50% like he did in the past, and that's just because financial size is an anchor to performance. So when you're working with billions, you just don't get the wide margins of safety. And Warren freely admits that if he were working with millions instead of billions, Warren would earn 40 to 50% a year right now.
Oh, yeah.
If you were working with smaller sums of money.
Yeah, exactly. I remember you were saying this during some, I'm not sure, in the university or some of the YouTube videos that I saw. Yeah. So what I'm going to do is I'm going to answer the next question is something really very personal. If you don't mind, can you share with the class and some of the viewers at home? But if let's say you can share the biggest mistake that you made, I mean in your investment journey, if you don't mind, can you share with us what is this biggest mistake and what have you learned, so that we can learn from your mistake as well?
Sure. I think everyone makes mistakes. We're all human. I'm certainly not perfect and far from it. I think one of my biggest mistakes would be I trusted someone who turned out to be unethical, and we all make mistakes. And speaking of mistakes, it's not necessarily failure, because mistakes aren't necessarily failure unless mistakes are accepted as such. I think mistakes can be viewed as a learning opportunity, and I tend to look at mistakes as an opportunity to learn and better myself and reevaluate, make adjustments, and move forward and try again. For example, even Thomas Edison failed over 10,000 times when he was inventing the light bulb until he finally found the filament that worked. And to quote him, he said he knew he would eventually succeed because he ran out of things that didn't work. So I guess to end your question with a positive, I would say fail early and fail often, and then find a solution that works.
Okay, thank you. So the next question goes something like this, because I know you spent a lot of time writing the book, and of course just now I was saying the Peter Buffett wrote the foreword. So if you don't mind, can you share with the class maybe an overall view about the book and what is it all about?
Sure. Well, yes, Cayden, you're right. Like you mentioned, Peter Buffett, the son of value investor Warren Buffett, wrote my book. And Peter, interesting. Peter is his own man. He's also an author and award-winning musician and philanthropist. And it's funny, Peter's become so successful that some people say that Warren Buffett is the father of Peter Buffett because Peter is so successful. So to answer your question, what my book is, it's also important to look at what the book is not. And the book is not a biography about Warren Buffett, and it's also not an autobiography about myself or about my value investing journey. But what my book is, it's really a how-to book that teaches readers how to value businesses. And I just simply explain multiple different valuation methods about value investing in a simple step-by-step process that's easy to understand. And I talk about in the book both qualitative factors and quantitative factors to use to identify high-quality businesses. So in value investing, price is what you pay and value is what you get. So that's a quantitative, but it's also important to factor in the qualitative criteria. Often the qualitative criteria can be more important than the qualitative. So the book talks about both the qualitative and the quantitative, and also the final chapter, what I think Peter Buffett really likes about the book is about responsible philanthropy. I think that really helps to differentiate my book about, after the book shows you how to earn money, it also teaches you how to responsibly give money away, and I think it's very unique in those aspects of everything that the book contains, with Peter Buffett's foreword, a very step-by-step, simple, easy to understand method how to invest like Warren Buffett, and then at the end, how to responsibly give money away. So that's kind of a 60-second version of the book.
Oh yeah, I saw it's chapter 15, Responsible Philanthropy.
Yes.
Third chapter today. Okay, so my last question before I hand the microphone to the floor is, yeah, of course I know you for a couple of years, and other than investing in high quality undervalued stocks, I mean, you consider yourself an investor in real estate as well. And I know as compared to US, Singapore is really such a small country, and there are plenty of land and houses over there. If you don't mind, can you just share with us, what makes you, get started in investing in real estate as well, in addition to undervalued stocks?
Sure. Many fund managers, they invest in equities only, with filter one being circle of competence. What makes us unique, we also invest into real estate as well. And right now, financial markets are fairly valued at the moment, and we believe we can earn good returns investing in other asset classes. So again, unlike most fund managers, identifying high-quality, undervalued real estate is also within our circle of competence, and this allows us to produce good, stable returns during periods while financial markets are fairly valued right now. It's interesting to note that, according to the World Federation of Exchanges, 15 years ago, there were about 9,000 publicly traded stocks listed on U.S. exchanges. That was October 1997, I believe. And now, almost 15 or 17 years later, this number has decreased from 9,000 down to only 5,000. And this shows a decline of about 4,000 publicly traded stocks delisted from U.S. exchanges. So as the number of opportunities decreases, we have to deploy capital responsibly. And in real estate at the moment, the distressed bank-owned REO real estate market is a good place for us to continue to generate optimal returns for our investors.
Okay. So from your own personal perspective, am I right to say that other than holding stocks, I mean, you yourself, you actually hold real estate so that it's like a portfolio or diversification, or how do you call it?
Yeah, we diversify the portfolio between publicly traded stocks and real estate. And there's some very large U.S. hedge funds right now deploying billions of dollars of capital into the distressed bank-owned REO properties right now in the United States. And real estate, there's micro markets. Florida is very different than, let's say, Illinois or Minnesota real estate market, and different than Singapore. Each country has its own nuances of the real estate market. So right now, there's a lot of distressed real estate properties in markets like Phoenix, Las Vegas, in Florida and other countries throughout the U.S. And we're just selectively looking for undervalued opportunities of high-quality assets. And we believe we can produce good returns even while financial markets are somewhat fairly valued right now.
Okay, thanks. By the way, this is more like a personal question, because after your session, we're going to talk about one public listed US company which is doing something on wooden flooring. Because in Singapore, it's quite different from US, because US is, am I right to say that in US all the houses are predominantly made out of wood? Is that right to say that?
That's true. However, in Florida, the houses are made of concrete block based on, there's termites because there's no winters, and also the homes are made of block because of the hurricanes. When the hurricanes come, the concrete block homes are stronger than the wood frame homes. So usually the wood frame homes in Florida are, older construction, maybe the 50s and 60s, before the builders figured out that they need to use concrete block.
Okay.
So the newer homes are made of concrete block in Florida.
Okay, concrete block. So in Singapore, everything is about concrete. Yeah, we don't have the houses really. Okay, so I'm just very curious about the flooring. Because in Asia, our flooring, we don't really use wood. We use like marble, like tiles and all that. Right. So I'm just curious about, in a very generic sense, in the US, what kind of flooring do the Americans is it wood? Is it tiles or marble?
Yeah, usually in the north, you'll see more wood and hardwood floors, because in the north United States, the winters they kill off the termites. But in the south, in Florida, for example, there's no snow. It's very hot here, very similar to Singapore. It's very hot and humid. And in Florida, there's a lot of termites, so we don't see so much wood construction or wood floors. So, and to answer your question, in Florida, we see more tile floors and granite and marble, just because the termites can't ruin those types of materials.
It's warmer. It's warmer in Florida.
Okay. Yeah, it's warmer. I think it's about right now. I'll give you the temperature. It's about, it's going to get up to 85 degrees today, Fahrenheit. So in Singapore, what is that in Celsius? What, 30?
85 degrees Fahrenheit, what's it in Celsius? But anyway, in Singapore, yeah, every single month is summer.
Yeah, right.
Yeah, so we.
I visited Singapore many times. I usually stay at the Ritz-Carlton in Singapore, and I love visiting there. As you and I talked in the past, I told you about my wonderful experiences there, and the people are always friendly. And most people don't own cars in Singapore, and the public transportation system in Singapore is outstanding.
The Singaporeans are laughing. Yeah. So, anyway, just to tell you a joke, most of the Singaporeans here, they say, in the entire Singapore, throughout the entire year from January to December, there are 3 seasons. Yeah. Usually in other countries there are 4 seasons. We're talking about like summer, autumn, and all that. So in Singapore there are 3 seasons. So number 1 is summer, which lasts throughout the year, and the second season is the monsoon season, which lasted from October until December. And there's another season that lasts throughout the entire year. It's called the shopping season. So it's all the 3 seasons that we have. Okay, but anyway, Scott, thank you. What I'm going to do is I'm just going to pass the microphone to some of the guys over here. And by the way, now's a good chance. After tonight, no more chance. Okay, very good. Anyone want to ask? So Scott, just give me a few seconds. So anyone to ask any question? Hey, don't need to say, otherwise I arrow you quickly. Okay, this side. Hey, just answer. Hey, no. Otherwise, no more chance to get quickly. Okay, very good, Cayden. We have Cayden over the microphone, so Cayden, you want to ask Scott?
Hi, Scott. Can you hear me?
Yes, I can hear you.
Okay. Basically, my question is from a book that I recently just read. It speaks about, let's say, investing in the right industry is practically half the battle won already. So, just my question towards you, is there any particular industry that you feel that it has an advantage over, let's say, from medical over commodities, or is there any bias that you feel would be better to invest in?
Maybe Cayden, you can look at the... Okay, can you just wait so that... Yeah, good.
Yeah, I couldn't hear all of the question. I heard parts of it. Could you... please repeat? I didn't hear all the question.
Maybe summarize your question.
Okay, my question would basically be, is there any... if let's say we were to say that investing in the right industry is about half a battle won, is there any particular industry that you would preferably like more than the other rest in your portfolio also?
Sure, that's a great question. When we look at businesses in which to invest, we would actually look at the entire industry. Some industries that we like, would be, the industrials where we can project out, like Mr. Buffett projects out into the future, what the businesses are going to look like, 7 and 10 years from now. Technology is outside of our circle of competence. So to answer your question, we don't invest in technology. The industrial sector is providing some opportunities right now. And when we look at business, we don't just examine that one business in a vacuum separate from the industry. We'll actually look at every single business within that industry, and we'll identify the top number 1 and 2 top leaders in that sector and industry. In fact, across all industries, we have identified the top 1 and 2 businesses within each sector. And then we'll look at which sectors are in our circle of competence and which ones aren't. For example, I mentioned, technology is not in our circle of competence. So how do we do that? Some factors to look at would be, return on equity, return on invested capital. In fact, can anyone tell me what the average return on equity is of S&P 500 stocks in the S&P 500?
S&P 500.
It's 12. So, for example, when we look at businesses, if the average is 12 return on equity, we look for the leaders would have a return on equity higher than 12. For example, some are 18 or 20 or higher. And as you're looking at return on equity to identify the top leaders, and there's other criteria as well. Don't just focus on a single set of criteria. Look at the entire business. But return on equity can be falsely inflated by using higher amounts of debt and leverage. So one way to fairly compare businesses across the entire sector is on page 116 of the current version of my book. It's called Debt-Adjusted Return on Equity. And that's a way where value investors can compare return on equity of entire sector. even with businesses with higher amounts of debt, that falsely inflates return on equity to appear higher than it really is. So just certain factors like that you learn throughout the years to fairly compare businesses within each sector, and then that way you can identify the top 1 and 2 businesses within each sector, and then those would be the businesses in which to invest if they're within your circle of competence and they meet the other test. Filter 2, sustainable competitive advantage. Filter 3 is management, and then finally filter 4, which would be the attractive price to value.
Okay, thank you very much, Scott.
Okay, very good. Any other question? Now last chance. 2 more questions. Someone you need to start already. Okay. Anyone? Quickly. Scott, there's one lady who say, is your book still on sale?
Yes, it is. Yes, it is. In 3 weeks, Amazon is going to distribute worldwide. Right now, it's in U.S. only through Amazon.
Oh.
And in about, I think, 2.5, 3 weeks, we've just signed a distribution agreement worldwide where Amazon is going to sell it worldwide. So I think about the 2nd or 3rd week of May, you'll be able to buy the book in Singapore in just about 2 or 3 more weeks.
Wow. So I guess I'm the only Singaporean right now who's holding a book.
I have some readers in Malaysia, but that's close to Singapore.
Oh, okay, very good. Another question. Anybody? Now's the chance to ask. So the book will be in the 2nd or 3rd week of May in Singapore and so on. Anyone else in this side? Anyone else? Oh yes, Terence. Terence, maybe you want to stand here so they can see you, and after that you can go and see. Okay, so you can, Terence, maybe you can come over here. Scott, this is Terence here.
Anyway,
Hello.
Let me on the microphone for you. Okay.
yeah. Okay, I just want to ask a couple of questions. Number one, what do you think are the market sentiments in the States with the interest rates rising? And then secondly, are you still managing your own? Are you managing a fund or a particular business that looks after consumers' capital or something?
Yes. Thank you for your question. As Cayden Chang mentioned, I'm the CEO and founder of Ameritrust Group, and currently Ameritrust Group, we invest in 2 asset classes, publicly traded stocks and high-quality, undervalued real estate. And the website is www.ameritrustcorp.com. And there you can learn more information or get in contact with my team directly. And that was the second part of your question. And the first part of your question was pertaining more to
interest rate.
Interest rates, sure. The interest rates in the United States are governed by the United States Central Bank, the United States Federal Reserve. And no one can predict exactly what rates will do. Go lower, stay the same, or go higher. But you're right. If rates go higher, that tends to have an effect on the economy that slows the economy. And of course, when the central bank in the United States lowers interest rates, that tends to ignite the economy, and people start borrowing more money because there's lower interest rates. So to answer your question, if the Federal Reserve were to raise interest rates, that would definitely slow the economy in the U.S. So no one can predict what the Federal Reserve is going to do. In the United States here, we have Janet Yellen is currently our Federal Reserve Chair, and I really think it's fantastic that we have. She's the first woman in the history of the Federal Reserve to have that position. The Federal Reserve was created back in December of 1913, so it's been 102 years. I think it's about time that we had a woman in that position. It's been too long, so I really applaud the United States for doing that. So I guess to summarize, when the Federal Reserve lowers interest rates, that tends to have a very positive impact on the economy because interest rates are lower, and private citizens and businesses borrow more money because of lowered interest rates. And if the Federal Reserve were to raise interest rates, citizens and businesses borrow less money because there's a higher interest rate, and then that tends to slow spending and corporate spending, and that tends to slow the economy. But thanks for your question. Good question.
Very good. Any other question? One last one before Scott go for his breakfast and start. Okay, last one. Precious question, quickly. One last one. Anyone? One last one. Anything? Now's the chance of the stocks or whatever. Anything you have in mind? Any something specific? Okay, Chris. Chris, maybe you may come here so that Scott can see. Let me do a test check. Okay, Chris. We have one young investor over here. Is probably what? How old are you, Chris?
22.
Hi, Chris. Yeah, 22-year-old investor.
Yeah. My question is, if the Fed raised the interest rate and if it slows down the economy, why would they do that? What benefit will the economy get in the long run? Or yeah, that's my question.
Hey, by the way, Scott is not an economist. I don't know whether it's a good idea.
True.
I should have asked Chris to come up. I'm just kidding.
Yeah, that's a good question. So that kind of falls in line with the previous question a little bit, but that's a good question. So the Federal Reserve, as they print money, that tends to devalue the currency. But the short-term effect is that it creates more spending. So situations like in 2008, when the United States experienced our big stock market crash in fourth quarter of 2008, the Federal Reserve stepped in and started increasing the monetary base in the United States. And as Warren Buffett stated in his interviews, he believes that has allowed the U.S. to get through that very difficult financial time. And as Warren mentioned, Merrill Lynch was very close to financial collapse before Bank of America came in and purchased Merrill Lynch. But the question pertains more of a economist area where I think my area of expertise is more value investing, but that is a great question. And as I previously stated, when the Federal Reserve Bank lowers interest rates, the economy tends to spend more money. And if the Federal Reserve Bank raises interest rates, the economy tends to slow down, and corporate spending and private consumer spending usually slows as well as interest rates increase. So, but I want to mention one thing, so I think we may be close to wrapping this up, is interesting in United States universities, and I want to ask the audience a question.
Okay.
In United States universities, value investing is really not taught in the universities. In the United States colleges and universities, they teach more the capital asset pricing model and efficient market hypothesis. And I think this could be part of the contributing reason why we have such big financial crashes in the United States. Value investing is very calm and rational and unemotional. It's very, fact-based and data-driven. And I guess my question to your audience would be, the universities in Singapore, do they teach more the capital asset pricing model and efficient market hypothesis, or are they starting to teach more value investing now? Or maybe you can tell me more about the Singapore universities.
I'm going to share with you an opportunity. So, as far as I know, and all of us, the Singapore University, they're still teaching the efficient market hypothesis. Yeah, so that's one. So, value investing in the public university in Singapore, there are probably, how many universities do you have? There are like 4. Yeah, 4 or 5. So, I think it's a combination of 4 public and probably more private. So it's a very small nation. So we have approximately 5.5 million population in the entire nation, and we have 5 universities. And as far as I know, for the 5 universities, none of the university actually teach value investing. So predominantly it's still efficient market hypothesis. We do have the local CFA institute, but they are not really teaching value investing per se. So we are a very small group. we are the very rare, like a couple of thousand, not 5 million who are going against the crowd. So we are
right.
But
I guess as long as universities and colleges continue to teach capital asset pricing model and efficient market hypothesis, that creates more investors doing irrational things out in financial markets. So that creates opportunities from which rational value investors can profit.
Yeah, exactly. So we are like a cop over here. So by the way, okay, no more question for Scott. Scott need to work. By the way, before we let Scott, call it a day, let me face the camera over here, so ladies and gentlemen. Now, before we let Scott call over here, so ladies and gentlemen, can we give Scott a huge round of applause? Thank you. Okay, thank you.
Let me end by saying one thing in Chinese. I know in Chinese, of course, there's Mandarin and Cantonese and many other dialects. I don't speak so much Cantonese, which I think might be more common in parts of Southeast Asia, but I do speak some Mandarin. So in Mandarin, I would say 我是美国人，可是我会说一点中文 which means I'm American, but I can speak some Japanese. Or I'm sorry, some Chinese.
Some Japanese. Okay, later can you give
working on English, as you can see. So, but I want to thank you all for your time, and you're all very brilliant, and I appreciate Cayden giving me this opportunity to interview. And I've been to Singapore many times, and I look forward to coming back to Singapore and visiting very, very soon. So thank you again very much for your time and the questions, and I look forward to seeing you all very soon.
Okay, thank you. Can you give Scott a huge round of applause? Thank you, Scott. I'm just going to just end this Skype call. By the way, I sincerely appreciate your help, and I'm looking forward towards the book being distributed in Singapore very soon. And I'll make sure that I'm going to buy a lot and I'm going to distribute among our graduates.
Oh, great.
Okay, thank you. So I'm going to chat with you again. So the next time, maybe the next person I'm going to chat a couple of months later will be Bart.
Sounds good.
Okay, thank you. Thanks a lot, Scott. Thank you. Okay.
Thank you.
We'll see you. Thank you. Okay. Wow.